Still a tricky environment for risk assets. Oil prices and the gold price rose again yesterday, continuing issues regarding the conflict in the Middle East and no real sign of any diplomatic breakthrough. Normally when geopolitical tensions rise, US bond yields fall as investors seek the safe haven of Uncle Sam. Yesterday and all this week and for the last few weeks, US Treasury yields have been rising and they rose again yesterday. The dollar has hardly moved since this conflict reignited a couple of weeks ago. So the question is why investors have not rushed to buy treasuries in this time. And if investors' reluctance to seek the dollar safe haven is fear of resurgent inflation, then Jay Powell's speech last night should have helped by saying that they would extend the rate pause, but it didn't seem to. I think what bond investors fear most is increased bond issuance. And concerns on that front will only have heightened in the last couple of days. Biden's trip to Israel basically cost the US taxpayer another $100 billion in aid, and that is the reality. So in essence, where the Fed has left off in pausing rates, bond investors have continued the tightening job that they're not prepared to do. And all along the maturity curve, rates have continued to rise. And this ignites a fear that the Treasury has got just this insatiable appetite for debt and that the Fed has lost control of the interest rate environment. So rant over on bond yields and why they're going up. In the UK today, we've had retail sales figures and consumer confidence figures, which both showed deteriorating trends, which I guess not really surprising given everything that's going on. In the UK, not much out. I've been looking at the real estate investment trust, which I've followed for a while, called Impact Healthcare REIT. It's produced a quarterly update, which is proving to be quite resilient in terms of its growth of its asset value and the collection of its rent. Impact Healthcare is a property landlord that owns 140 care homes. These homes are leased to a hand-picked group of operators on long-term inflation-adjusted leases with an average term of 20 years. So you might ask what could possibly go wrong. But what it does is construct dependable income and dividend streams from investing in what the market would term as alternative assets. And in this case, it's care homes. And these vehicles became very popular and raised lots of capital from yield starving as investors struggled to find yield elsewhere. However, today, investors are pretty overwhelmed with the opportunities to get yield. I mean, you can get a 5% risk-free rate by lending it to the US government. So owning care homes or assets such as music royalties, which is also sort of flavour of the month, involves operational and financial risk. So these vehicles need to offer a premium yield to the yield that you can get on the so-called risk-free rate. These are really interesting situations in the stock market now, and Impact Healthcare, which has done a perfectly tidy job of preserving the value of its assets in the last 4 or 5 years, now trades at a 30% discount to that stated asset value and yields 8%. So the issues are going to remain until the interest rate cycle changes, but it just sort of demonstrates the pressures that these manufactured bonds that came into the market in previous years, how they're struggling to keep up in a changing interest rate environment.